This video goes over the rules of debit and credit as well as normal balances of accounts. This is probably the most important concept in accounting. Let's examine what's on this slide. We know assets equals liabilities plus owner's equity, and owner's equity is made up of owner's drawn account, capital account, not shown on here, but we'll go over it, and income statement accounts, revenue and expenses. Let's establish the fact from an earlier video that debits means left side and credits means right side. So all accounts have debits and credits. Debits again on the left side, credits on the right side. Now, for each specific account, the left side, what we call debit, is where we might record the increase of the account balance, and the right side, the credit side, is where we record the decrease of the account balance, or it could be the reverse. For certain accounts, we might record the increase on the credit side and the decrease on the debit side. Let's take a look at assets. For all asset accounts, the increase will be on the debit side and the decrease on the credit side. So for any business transactions, we need to record to an asset accounts such as cash, accounts receivable, inventory, supplies, any prepaid expense accounts like insurance. And we have an increase, we would record it on the debit side, the decrease on the credit side. For liability accounts, like accounts payable, the increase is on the credit side and the decrease on the debit side. So liabilities is the opposite of asset, just like accounts payable is the opposite of the asset accounts receivable. Owner's equity, in total, we would see the increase on the credit side and the decrease on the debit side. However, for the owner's equity accounts, we need to examine each individual account and record it accordingly. For example, owner's drawn account, the increase is on the debit side and the decrease on the credit side. Capital is opposite of drawn, so the increase is on the credit side and the decrease on the debit side. Any transaction involving the revenue account, like fees earned, the increase in the balance is recorded on the credit side and the decrease on the debit side, in opposite of expense accounts. Any expense accounts like utility expense, repair expense, the increase is recorded on the debit side and decrease on the credit side. Let's briefly review. All asset accounts increase on the debit side. Liabilities is the opposite of assets. So liability accounts increase on the credit side, opposite of assets. Owner's equity, on the other hand, varies. The drawn account increase on the debit side, while the capital account increase on the credit side. Revenue increase on the credit side and expense increase on the debit side. So drawn under owner's equity and expense also under owner's equity increases on the debit side. Both increase on the same side, the debit side, the left side. And that makes sense because both drawn and expense have the same impact on owner's equity. Both decreases owner's equity. Revenue account increase owner's equity, so does capital account. It increases owner's equity. Therefore, both revenue and capital increases on the credit side. Okay, so how can you remember all that information? You must spend 15 to 30 minutes, definitely recommend, to study and memorize the concepts of debits and credits. It will go a long way in making it easier for you to learn in this class. To help you, there are cheat sheets available as handouts and could be downloaded on Blackboard under the Chapter Resources folder. The sheet that I find most useful is this one right here. On this one, it says after eating dinner, AED. A for assets, E for expense, D for drawing. So all of these accounts, any of the accounts that are assets, expense, and drawn, increase on the debit side. All other accounts increase on the credit side. Let's read comics. LRC, liability, revenue, capital, increases on the credit side. However, you actually don't have to remember the second part. Just remember the first part, AED. AED, after eating dinner, assets, expense, drawn, other accounts that increases on the debit side. All other accounts increase on the credit side. Back to the slide here. In each account, understand that there could be multiple transactions. There are transactions that increase while others decrease the account balance. The sum of the increases in an account is usually equal to or greater than the sum of the decreases in the account. In other words, when netting all of the increases and decreases activities in the account balance, it will result in the net increase. And this could be a debit or it could be a credit account balance, depending on the account. We call this the normal balance of the account. Again, the sum of the increases in an account is usually equal to or greater than the sum of the decreases in the account. Thus, the normal balance of an account is either a debit or a credit, depending on whether increases in the account are recorded as debits or credits. Take assets, for example. The normal balance is the debit side. It is where we see the increase. For example, cash. Under assets, cash account, there will be many transactions occurring. Some increase in cash, other decrease the cash, depending on cash is received and cash paid out. The balance at the end of the accounting period, would there be more increase or more decrease, you think? There would be more increases, right? So the ending balance of cash will be on the debit side. And the debit side is called the normal balance of the cash account, just like it is the normal balance of all assets accounts. All of the green shaded boxes on the slide shows the normal balance of the types of accounts. If at the end of the accounting period, the balance of cash is a credit, meaning more decreases in activities than increase, then what does that tell you? Something was wrong. It means the company had spent more money, more cash than it has, and that cannot be right. So the recording of the accounting transaction was probably done in error. Think of the cash account having increases in the account balance because of capital, because of fees earned from providing services. Think of decreases because of drawn and from spending on expenses and buying supplies. The outflow, the use of money, cannot be more than what's available in the account balance, right? So at the end of the period, there must be a positive account balance, meaning that there's more activities that increases the account balance than the transactions that decreases the account balance. And at the end of the period, the normal balance will be on the debit side for cash as well as for all assets accounts. While for liabilities like accounts payable increases on the credit side. An account balance is established when there is something purchased on account, and so that balance is on the books, and that balance is recorded as a credit. When that balance is paid off, it will be debited to offset some of that account balance or offset all of it. And then additional accounts payable balance is built up, but at the end of the period, the normal account balance will be on the right side, the credit side, and we call that the normal account balance. Revenue account such as fees earned is recorded when services is provided to the customer and the revenue is earned. So money received is recorded to the cash account as a debit to cash and a credit to fees earned. In this account transaction balance, we will see transactions after transactions. These activities will show fees earned for the services provided, and the account balance would increase and increase. At the end of the period, we would see the normal account balance being on the credit side for the increase of this account balance. On the other hand, expenses for spending money, a credit to cash account and a debit to expense accounts such as utilities expense, wages expense, supplies expense, and all these expenses are recorded to the debit side because debit is when the account balance is increased. And at the end of the period, we see the normal balance being a debit balance for expense account, opposite of revenue account. Similarly, for a drawn account, that's when money is taken out of the business for personal use by the owner. So the cash account is decreased and cash would be credited, and the drawn account would be debited. Debited to show the increase of the drawn account. At the end of the period, we will see a normal balance on the debit side. In contrast, the capital account. Capital account is from injecting money into the business. So the cash account would be debited for an increase of cash, and the capital account would be credited for the increase of capital. The capital balance would increase and increase anytime there's capital activity, and the normal balance at the end of the period would be a credit balance to represent the increase of the capital or a positive amount of capital. Just as an aside, the capital account as well as the revenue account has a positive impact on owner's equity. On the other hand, the drawn account and the expense account has a negative impact on owner's equity. So when there's an activity that increases these account balance, we debited them. We debit them to show the increase of the drawn account and expense account. But by debiting these, it has a negative impact. The increase of drawn and expense accounts decreases owner's equity. On the other hand, the credits to revenue and capital account increases owner's equity, because the credit means the increase of revenue and the increase of capital. It also increases owner's equity.